The year was 2008 and it was January when I applied for what was touted to be the largest IPO the Indian market had ever seen, Reliance Power. For once, I actually got an allocation, which almost never happened for me otherwise. The issue closed oversubscribed nearly 73 times. There was a real euphoria around it. And then on the 11th Feb, it listed, right into the market that had already started cracking a few weeks earlier. The stock briefly touched a high and then just fell apart. It closed the day 17% below the issue price. It never ever really recovered from there. It was all over the news, times were bad. But why am I telling you this story? Because looking back, I was being completely naive, blindly applying for an IPO because everyone else was, with zero understanding of what I was actually buying into. And I paid for that stupidity. A few years later, I was reading Benjamin Graham's The Intelligent Investor and I ran into a line that took me straight back to 2008. Graham writes in the context of new listings, for every dollar you make in this way, you will be lucky if you end up by losing only two. And that was it. That was exactly it. And that line sent me down the rabbit hole, trying to actually understand what an IPO is, the concept that is, and whether the people applying for them on an average come out ahead or behind. What I figured then is what I want to share with you today. And here's the interesting part, almost nothing seems to have changed since then. The mad rush to chase the listing pop and the outcomes that usually follow it, both are still exactly the same, 17 years later. And I'll show you the data. And that's what this episode is all about. I'm your host Sandeep Rao and let's dive in to understand what IPOs are about and if it makes sense to chase them. Before I start, here's the disclaimer. The examples and ideas shared in this episode are strictly for educational and illustrative purposes only. Nothing discussed here should be construed as a recommendation, investment advice, or a solicitation to trade. Trading in stocks and derivatives involves significant risk and can result in complete loss of capital. The examples and data presented are meant to explain market behavior and not to suggest that similar outcomes will occur in the future. Like I always do, I'll start by explaining the IPO process. This can get a tad bit long, but stay with it, as it's key to understanding the whole IPO dynamics. Let's start with a company. Call it whatever you like, a D2C brand, a fintech, a manufacturing firm, doesn't matter. And it's private at the moment. It has founders who started it, and somewhere along the way they probably took on outside money. Angel investors early on, then a venture capital fund or two, maybe a private equity round later as it got bigger. At the end of it, each one of these investors owns a slice of the company sitting on what's called the cap table. Those shares are not traded in a market. So if a VC wants to sell their shares, they can't just log into an app and hit sell. They have to find a private buyer, negotiate a price, and hope the company's shareholder agreement even allows it. That illiquidity is a key aspect of this story. Private ownership is real ownership, but it's frozen. An IPO is a mechanism to unfreeze it. In India, there are two distinct paths a company can take to get listed. There's the main board IPO, which is what we hear about when the word IPO is mentioned. Large established companies listed on the main NSE and BSE exchanges, reviewed directly by SEBI. Then there's the SME IPO, a separate dedicated track for much smaller companies listed on the NSE Emerge and the BSE SME with a different set of rules. For this episode, we are going to focus almost entirely on the main board. That's where the bulk of the money goes. Let's now go a level deeper to understand how a company gets listed through the main board path. Step 1, the company decides to go public. Then it appoints one or more merchant bankers. SEBI calls them book running lead managers, along with a registrar, legal counsel, and auditors. These bankers now run the whole show technically, though the company obviously drives the larger narrative. Then comes due diligence. The bankers and lawyers go through everything. Audited financials for the last several years, every material contract, litigation history, related party transactions, promoters' background, licenses, statutory filings. All this feeds into a document called DRHP, the Draft Red Herring Prospectus. Think of of it as a company's life story laid bare with every risk factor it can think of listed out, precisely so that no investor can later come and say, "Nobody told me about it." This DRHP goes to SEBI. SEBI now checks whether the disclosures are complete, consistent, and not dressed up in some kind of a promotional language. This review typically takes 1 to 3 months and sometimes longer if SEBI keeps sending back queries. Now, to even qualify for the main board in the first place, the company needs to clear one of the 2 bars. These 2 bars or routes to IPO are worth understanding properly. The first is the profitability route. This is the classic conservative approach. Companies should have net tangible assets of at least 3 crores in each of the preceding 3 years and the average operating profit of at least 15 crores in 3 of the preceding 5 years. In simple terms, the company has to prove that they are actually running a profitable business consistently for years before they let you raise money from the public. The second is the QIB route. This exists for companies that simply don't have that kind of profit history. A lot of new age tech and platform businesses fall here because they've spent years prioritizing growth over profitability. Companies like Zomato and Swiggy listed through this route. Instead of proving a profit track record, the company has to now allocate at least 75% of the issue to qualified institutional buyers. They are big, sophisticated institutions like mutual funds and insurance companies. The logic is that if these institutions, who presumably have the resources to do serious due diligence, are willing to put up 75% of the money, that itself is treated as a credibility signal standing in for the profitability the company doesn't yet have. And if that 75% threshold isn't actually met, the entire issue is refunded. Now, once SEBI clears the DRHP, it becomes the RHP, that is the red herring prospectus, which carries the actual price band, say 95 rupees or 100 rupees. A day before the issue opens, a chunk goes to the anchor investors, large institutions committing at least 10 crore each, whose participation is meant to signal quality and help anchor the price. Then the issue opens to retail, HNIs and the rest of the QIB pool, typically for 3 to 4 days, and this is where book building happens. Meaning, investors bid within that price band and the final issue price gets set based on where demand actually clusters and not necessarily at the top of the band. Now, from your perspective as an applicant for an IPO, your money doesn't yet leave your account when you apply. It just gets blocked via ASBA until allotment is decided. Now here's a quick explainer on the screen as to how ASBA works. So now that we have some sense of the mechanics of an IPO, a more interesting question worth asking is, why is there such a relentless frenzy among retail investors whenever a new IPO hits the market? Now I thought about it, and here are a few reasons why this could be the case. There are many people who look at IPOs as lottery tickets. The idea is to sell allotments immediately upon listing to capture short-term gains. This, I feel, is the fundamental driver. The other thing is participation in IPOs is now quite cheap and very effortless, with minimum lot sizes of around just about 15,000 and 2-click UPI mandates. Entering the primary market is accessible to almost anyone without having to get into any kind of cumbersome paperwork. Furthermore, the ASBA system removes financial friction by keeping application money in your bank account, where it continues to earn interest until the shares are actually allocated. So this seemingly zero-risk setup fuels a speculative listing gain mentality. Evaluating businesses for long-term compounding is, I guess, the last of the priorities for many. Finally, relentless coverage from brokers, news channels, and financial influencers supercharges the cycle. On top of it, the constant attention economy creates widespread FOMO, often giving even mediocre companies far more hype and oversubscription than what their underlying fundamentals justify. But you see, the problem is, if the issue is oversubscribed, which most hyped ones are, allotment for retail is essentially a lottery run by the registrar. And if you don't get shares, the block is released and the money is back in your account, untouched. The shares that do get allotted then list on the exchange, typically within 3 days of the issue's closing, and that opening trade is the listing price, discovered fresh on the open market, which may sit well above or below the issue price depending entirely on how the market feels about the stock that morning. That's pretty much how the mechanics of IPO work, and now you also know why the IPO frenzy happens. Now, before I move on, let me talk about something you'll most certainly come across whenever an IPO opens up. You'll often hear people say an IPO has a GMP of 100 or 200, almost as if that guarantees a strong, solid listing gain. The reality is that grey market is obviously an unofficial market. It's obviously not regulated by SEBI, transaction volumes aren't publicly disclosed, and the prices you see are at best based on a relatively small set of participants. So while the GMP can be looked at as an indicator of market sentiment, it's anything far from a guarantee. We've seen IPOs with high GMPs disappoint on listing day and others with a modest GMP surprise on the upside. So treat the grey market premium as a sentiment indicator, not a prediction as to where the stock will list. So far, we got a sense of the process of how a private company becomes a publicly listed company and all the other factors like ASBA and GMP that come into play. But now I want you to look at it at an individual level. As a retail investor applying for an IPO, you are expecting an IPO pop, a listing pop, which means you got it allocated at 100. You expect it to list at some profit, 110, 120, 200 maybe, and why not? In fact, that expectation is usually more speculative than based on any sound logic because it ignores the fundamental incentives driving the IPO market. So here I want to share with you two key aspects you need to understand about the IPO market, something no one would tell you. But before that, here's a quick note. I know I'm oversimplifying things here to make it more accessible for a larger audience. Obviously, IPO pricing is far more nuanced than the way I'm explaining it over here. Okay, so the first concept that I would want you to understand is that of the winner's curse. You see, if an IPO is priced correctly or assumed to be underpriced, it's likely to pop. Informed institutional investors will swarm the offering. The issue would become heavily oversubscribed, and because of rationing, your odds of getting a meaningful allotment would be tiny. Now, conversely, if an IPO is overpriced and fundamentally weak, smart money would stay away. The issue would end up undersubscribed, and the underwriter is more than happy to give you 100% of the allotment you requested. As Kevin Rock in his seminal 1986 paper demonstrated that when you win a full allotment in an IPO, you have effectively been cursed. You've been handed the shares that the informed players actually rejected. So retail investors are structurally excluded from the good deals and forced to hold on to lemons. So your win at allotment actually becomes a curse. The second aspect you must understand is the conflict of interest between the primary and the secondary markets, or the exit liquidity dynamics as they call it. When a company goes public, many a times it's not about raising capital for growth. It is an exit event. Early venture capitalists and private equity investors have held illiquid, risky stakes for years. For them, the IPO is a liquidity event they've been waiting for. The moment they can finally cash out. As Pagano, Panetta and Zinclays documented in their empirical study, IPOs are often associated with equity sales by controlling shareholders. In the primary market, these insiders are looking to monetize their success at peak cyclical valuations. When you buy into an IPO, you are essentially providing this exit liquidity for early stage backers. As a secondary market investor, you are stepping into a game where the company has already been priced to perfection by the people who have held the asset for years. So in that context, the IPO market is designed to benefit the issuer, not the retail buyer. Understanding this structural reality is key. If you are a secondary market investor, the most rational move is often to wait and let the initial volatility subside, maybe wait for a quarter or two for the public financial disclosures, and let the winner's curse play itself out. Ideally, I wouldn't want you to let the madness of the crowd or the allure of the listing pop drive you to buy into what could be lemons. And I know for sure you won't trust me, so let me share some data with you. So here is what I did. I took all the main board IPOs between 2020 and now. I have excluded SME IPOs as they follow a different listing framework. I also made sure that whenever a company has undergone a bonus issue or stock split, I have adjusted both the IPO issue price and the current share price. This ensures we are comparing apples to apples while calculating returns and all the performance metrics presented in this analysis. Before we look at returns, let me take you through the sample data. You see, since COVID bull market, which began in March 2020, India has seen approximately 400 main board IPOs. After just 14 IPOs in 2020, activity picked up sharply with 64 in 2021. Issuance slowed a bit in 2022 before rebounding to 90 IPOs in 2024 and a record 104 IPOs in 2025. It is often said that IPOs only flood the market during a raging bull market, but what's interesting is that despite the broader market going almost nowhere over the last 2 years, companies continue to come to the market in record numbers. And even in a lackluster year like 2026, by mid-July, we've already seen another 30 listings. Now let's look at the outcome most IPO applicants care about, the listing day pop. Out of the 400 mainboard IPOs in our dataset, 286 closed above the allotment price on listing day while 113 closed below it. So in other words, roughly 7 out of every 10 mainboard IPOs delivered a listing gain. So historically speaking, investors who received an allotment and exited on listing day would more often than not have made some profit. But that's only one part of the story. As of 17 July 2026, 245 of these IPOs are still trading above their issue price, while 154 of them are trading below it. What this tells us is that the listing day performance and long-term performance can be very different. So let's now dig deeper into the data and see how these IPOs have actually performed over time. That is the long-term returns. Now let's look beyond the listing day and see how IPOs have actually performed over different holding periods. Now, before we go about interpreting these tables, there are two important things we need to understand. One of the things you'll notice is that the sample size or N keeps reducing as we move from 1 month to 1 year. And that's because newer IPOs haven't been listed long enough to complete those holding periods. For example, an IPO listed just 3 months ago can't really have a 1-year return, so it's excluded from that calculation. And also, these are median returns and not average returns. In other words, we've sorted all IPO returns from the lowest to the highest and picked the middle value. I prefer the median because a handful of extraordinary winners can heavily skew the average, which doesn't happen with the median. The first table assumes you received an IPO allotment. So the returns are calculated from the adjusted issue price to the adjusted market price after 1 month, 3 months, 6 months and 1 year, and as of today. Now, if you look at it, the story changes a fair bit when we switch to the second table. This assumes you didn't receive an allotment and instead bought the stock at the closing price on the listing day, which I think is more realistic. As you can see, the median returns are much lower, even turning negative over several holding periods. In other words, if you missed the IPO and bought it after the listing frenzy, your experience was on an average very different from those who got an allotment. And finally, take a look at the maximum return column. One IPO has delivered a staggering return of over 3000% from its issue price. Do you know which company it is? Pause the video and leave your guess in the comments, and let's see how many of you get it right. Before we move on, there's an important point to keep in mind. Even if you were lucky enough to receive an IPO allotment, your investment was probably around 15,000. Unless you continued buying more shares after listing, it was unlikely to become a meaningful part of your portfolio, even if the stock went on to become a 10x or a 20x winner. What it definitely gives you is a great story to tell at parties and loads of bragging rights. But I'm sure most of you have heard of every company on this list, and I'm really not surprised. Companies that perform exceptionally well receive constant media coverage, analyst attention, and social media buzz. When share prices keep hitting new highs, almost everyone wants to talk about them. You would too. Now let's be fair and look at the other side of the distribution as well. I'm willing to bet that most of you haven't even heard of many of these companies. In fact, before putting together this analysis, even I hadn't heard of several of them. And that's precisely the point. The biggest IPO winners become household names while the biggest losers quietly fade into obscurity. But they're just as important because they remind us that not every IPO is a wealth creator. Some of these companies have gone on to destroy almost all investor capital, falling as much as 99% from the issue price. You see, I'm reminded of this saying, which is a falling tree makes more noise than a growing forest. But in the context of the IPO market, the opposite seems to be true. Success is so damn loud that it gets all the headlines, media coverage, and investor attention. And failure is surprisingly quiet. The biggest IPO losers slowly disappear from public memory, making it very easy for us to remember only the winners and believe IPOs are always a great investment. So you may ask, what is the conclusion based on all this data and analysis? Well, first, not every IPO is a bad investment. In fact, around 7 out of 10 mainboard IPOs delivered a listing gain, and some have gone to become extraordinary wealth creators as well. But we've also seen that chasing every IPO simply because it's popular or because the grey market premium looks attractive isn't a strategy either. Behind every Mazagon doc are companies that have destroyed 70, 80 and even 99% of investor capital. The biggest lesson I feel isn't that you should avoid IPOs altogether, but to be more selective and serious about it. Listing gains is good, but unless you want to commit more capital post-listing, it's not a great idea to just chase the pop. Lastly, evaluate it the same way you would evaluate any other business. Understand what you're buying, why it's being sold, and whether the price really makes sense. Perhaps that's what is Benjamin Graham's lesson from all those years ago. Don't let the excitement of a new listing replace good investing principles. So yes, that brings me to the end of this episode on IPOs and whether you should be chasing them. I hope you found it useful. If you have any questions, feel free to ask them in the comments. I will try my best to answer them. Thank you. Until then, take care and trade soon. I'll be back soon with the next one.